सर्वकार्येषु सर्वदा त्वमेव माता च पिता त्वमेव बन्धो च सखा त्वमेव विद्या द्रविणं त्वमेव सर्वं मम देव कायेन वाचा मनसेन्द्रिये वा बुद्ध्यात्मना वा प्रकृति स्वभावा करोमि यद्यं सकलं परस्मै नारायणायेति समर्पयामि गुरु ब्रह्मा गुरु विष्णु गुरुर्देवो महेश्वर गुरु साक्षात् परब्रह्म तस्मै श्री गुरुवे नमः ॐ सहना भवतु सहनो भुनक्तु सह वीर्यं करवावहै तेजस्विनावधीतमस्तु मा विद्विषावहै ॐ शांति 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 सर्वने जय श्री कृष्ण.
Jai Shri Krishna, Badare. And we pass over to...
He's not co-host, sorry.
That's what I'm doing, Rohini. We'll pass over to Dipesh Bhai. Dipesh Bhai. Jai Shri Krishna. And you should have co-host now. You should be able to unmute. Yep, you are. Okay. Over to you, Bhai.
Good evening, Jai Jinendra, Jai Shri Krishna. Lovely to see the RPM family again. Thank you, Rohini Ben, Paresh Bhai, and of course, Ba for the lovely prayers. So yeah, today's topic is inheritance tax planning, inherently unfair. Like Paresh Bhai said, I've actually had quite a few nice phone calls from members of the RPM family from the previous presentations, and they were really happy that they were able to get the answer pretty quickly, and it helped to put their mind at rest, so they didn't need to worry about the thing that was worrying them. So what I'll do is I'll start sharing the screen. I'll go through the presentation slides. If I can ask for questions, if you can put them in the chat, or hold on to the questions until the end, and when we get to the end of the presentation, we will have time for question and answer. And if we run out of time, or we don't get to go through all the questions, or you need a little bit more just explaining, then of course please feel free to contact me. Happy to help you with from that point of view. So let me share the screen. Right, so welcome to today's presentation. Like Paresh Bhai said, we did this or Rohini Ben said, we did this presentation this time last year in June. There was a very good response to that presentation. There were lots of questions, and I'm sure there'll be lots of questions today. Sometimes because the topic is a little bit complicated, it takes, some people like to listen to it a few times before it starts to make sense. So hopefully this will help you with your understanding of inheritance tax. Now, the presentation has been called Inherently Unfair. The reason for this is that the Chancellor himself has said that the inheritance tax system in the UK is overly complicated and it's really unfair. So what we're going to have a look at is I'll give you a little bit of background about St. James's Place, about myself, my company, Oakdale Financial Services. And then what we'll do is we'll have a look at some of the planning that you can do, which will help you to save the inheritance tax. The main aim is to make sure that as much of this money stays with your family, we can pass on as much of this money to your future generations and make sure it's done in a tax efficient, in a legal way, so that you don't have anything to worry about later on. So St. James's Place was founded in 1991. During that time, it's become a FTSE 100 company, so one of the largest 100 companies in the UK. St. James's Place currently look after 148 billion worth of client funds under management that we look after for different clients, various different clients across the world. How we work is we provide trusted face-to-face advice. So the idea is that we want to make sure that we're able to give you good advice, help you with whatever's worrying you. And usually there's always a solution, there's always a plan of action that can be adopted or followed to make sure that you've got that peace of mind, your planning will work as you want it to, and that the money can pass on to future members of your family. There's access to a wide range of products and services. And one of the really important things with St. James's Place and my advice is that my advice is guaranteed by St. James's Place, a FTSE 100 company. So what that means is if the advice is found to be incorrect, then they will put you back in the original position before the advice took place. So a little bit of background about myself. I've been in financial services since 2006. So I've got over 15 years of industry experience. Some people have said to me, I don't look that old to have 15 years of industry experience, but yeah, I've definitely been advising since 2006. Now, during that time, we've managed to help many families, many individuals with all various different areas of financial planning. We've helped them with their investments, their pensions, their inheritance tax, just making sure that their financing has been done all correctly, that you're up to date with the latest rules. Now, one thing we have to be aware of is that the rules do change on a regular basis, allowances, budgets, taxation. And to make sure to be able to do our job properly, to be able to advise clients correctly, we have to spend a lot of time doing reading, continuous professional development to make sure that we have the latest knowledge, the latest information, so we're able to advise correctly. So really, the main purpose of today's presentation is really to help have an understanding of inheritance tax. So if you've already got some understanding or you've started to think about it, hopefully this will explain it in more detail. And for some people might not have thought about inheritance tax. This might be the first presentation you're coming along to. You might be thinking, I really haven't done anything. I need to start thinking about some things. Then hopefully this presentation will give you some ideas, some food for thought, and some actions that you can carry through that will help your planning and help your family in the future. The key thing is we want to make sure that we can mitigate the impact, the financial impact of inheritance tax, which is 40%. So what we'll have a look at today is we'll have a look at concerns that people have in relation to inheritance tax planning and also financial planning in general. We'll have a look at some initial planning ideas, some things that you should take into consideration. Nil rate bands, what they are, how much they are, how they work. We'll have a look at there's some special rules where assets are over £2 million. There's some additional tax complications that you need to be aware of. There's the problem of inheritance tax at 64%. Yes, that's not a typing mistake. There is also inheritance tax at 64%. There is gifting exemptions that you can make use of. And we'll have a look at how the 7-year rule works in terms of taper relief. We'll also look at, for example, wills, lasting power of attorneys, really to make sure that your estate is set up as tax efficiently as possible. Of course, we will have a look at various different types of trust planning that you can use to help with your planning. And we'll also look at a different type of scenario, which is using whole of life cover to cover any inheritance tax liability you have. A couple of other things we'll touch upon will be enterprise investment scheme, business relief as well. And we'll have a look at some planning around the main residence, some of the things that you can do, and some of the pitfalls that you have to be aware of. And then the value of an investment with St. James's Place can increase as well as decrease. So that's just for information. So, and then we'll have a question and answer session at the end of the presentation. So these are some of the concerns that we come across on a very regular basis when we have meetings with clients, when we do presentations, conversations with people. A lot of people, you will find that these concerns that they've got will be probably very similar, very relevant to concerns that you have as well. So the main concerns are around inheritance tax, the amount of money that has to be paid. So there's going to be a cost to the estate. The value of the estate is going to be increased, is going to be decreased by the amount of inheritance tax that's got to be paid before the money can go to your family. And also you want to make sure that you're able to pass on money and assets to future generations. You have to pay 40% tax at the point of death after paying tax throughout lifetime. So if you think about it, during your lifetime, you pay various different types of tax. You pay income tax on any income you earn, on any rental income you receive from buy-to-let properties. You pay national insurance contributions. You pay stamp duty when you buy property or when you buy shares. You have to pay capital gains tax. So this is tax on gains that you've made during your lifetime. So you buy an asset, you make a gain, you sell it. If in that scenario, there'll be capital gains tax to pay, council tax. There's various different types of tax that the government applies. So from a tax point of view, we're actually one of the highest countries in terms of the amount of tax that we pay. One of the things that people say is, of course, they want to give the money away to their children, but what happens, what control will they have? It's a lot of people have said that it's important to have some degree of control, because once you give the money away, that's it, the money's gone. There's no guarantee that you'll get the money back. You may need access to money in the future after giving it away. So you might think, okay, we don't need this money, we'll give it all away. But then you're not leaving yourselves enough money, just because you have to think about what happens if circumstances change in the future, if your health changes. You need to make sure that you've left enough money for yourself as well. And then what we talk about is systematically giving away a little bit of money every year, rather than trying to give it away all in one go. It might be better to do it a little bit at a time if we give it enough time. If we haven't left enough time, then yes, of course, you're going to have to give away larger amounts. People also talk about 7 years is too long to wait. So how it works is when you give money away, as long as you survive 7 years, that money will be outside of your estate from a inheritance tax point of view. Now, imagine the scenario where you're already elderly, you've got some medical health conditions, you might not survive 7 years. There might also be some other unforeseen factors or unforeseen medical illnesses that were unexpected, and that might have an impact on your life expectancy and your ability to survive seven years. We know that a lot of people say that they don't have enough time to plan their wealth, their financial planning, their estate planning, because there's just lots of things going on in life. There's lots of things to deal with. And the rules are changing, the taxation, the budgets, the allowances. So unless you're looking at this stuff on a regular basis, it's very difficult to keep up to date with all the various changes and how it impacts you. And people always say they're not sure if what they're doing is enough to achieve their financial objectives. So this means you've got to know what your financial objectives are. You have to sit down, you have to think about your financial objectives. What is it you are trying to do? What is it you are trying to achieve? Maybe you've got to write it down to help you as well. And a lot of people do say that they're not 100% clear on their financial objectives, or they've got some idea what they would like to happen, but they don't know how to pull all the pieces of the jigsaw together. And that's where we can help a lot of clients, because we've got an understanding of the wide area of inheritance tax as well. So we need to put together a solution that meets your requirements, adapts with changes in taxation, budgets, allowances. So here what we'll do is we'll have a look at some initial planning ideas, some things that you could do to start off with. So the first thing we will say is that ensure you make use of your ISA allowance. So the ISA allowance for an adult is £20,000, whether it's a cash ISA or an investment ISA. Now, usually from around about March time, March, maybe beginning of April, up till the 5th of April, everyone is rushing to use up their ISA allowances, put the money into ISA. Some people will be doing it from the beginning of the tax year, which has just started last month. But the information that you always get given is make sure you do your ISA, make sure you do your ISA. Now, ISAs are efficient from an income tax point of view and also from a capital gains tax point of view, but they're not necessarily friendly from an inheritance tax point of view. So just think about it, money that you've got in cash ISAs, at the moment, the rate of return on cash ISA, because the interest rates are very low, the rate of return is also very low. Yes, I know that the interest rates have gone up earlier this week, but what we have to realize is that the interest rate that you're going to get overall, the interest rate is still very low compared to what it had been historically. So rates are low, you're going to get a low rate of return on your ISAs, and that money is going to be in your estate for inheritance tax. So let's say, for example, you have £100,000 in your ISA. You're probably getting a rate, maybe let's say 0.5% or even 1% if you're lucky. If you're getting 1%, that's £1,000 a year. But at the same time, if you pass away, this money is then in your estate. So you could end up losing £40,000 or 40% of this money in an ISA. So clearly you can see that's not going to be making the most efficient use of the money available, and it's not really good use of ISA. It's tax efficient, but the interest rate is so low, it doesn't really help to be tax efficient on a very low rate. So yeah, they always talk about using ISAs, but from an inheritance tax point of view, they don't help you. It's worth having ISAs from a liquidity point of view. You need access to the money. Yes, absolutely fine. You should certainly consider maximizing contributions to your pensions. So where you've got earnings, you can put in 100% of your earnings. If your earnings are up to £40,000, you can put in £40,000 in the current tax year. Obviously, you have the ability to go and use carry forward of the previous year's allowances if your income is sufficiently high. So pension contributions are great. We really like them because of all the changes that have come into pensions. And any money you put into a pension will also be outside of your estate immediately. You've also got, if you own a company and you're worried about taking more money out from the company as salary because you're going to have to pay more tax, you don't need to take out any more dividends because you're already drawing enough. Then the problem you have is that the money you have sitting in the company is not earning any returns. So you may wish to put the money into a pension, company pension, where the company contributes and you save the corporation tax. And again, that's going to be money that's going to be available to you later on in the future. So with pensions, how it works is you have to use the current year's allowance first. So we are in the 2022-23 tax year. You have to use this year first. If you have additional money and you've got additional income, then you go back to the first of the 3 years. So that would be 2019, 2020. After you've done that, then you can do 2020, 2021, and so on. So certainly pensions have a lot of tax advantages in terms of tax relief from income tax or corporation tax, the fact that they grow free of income tax, capital gains tax whilst they're invested. And of course, they can help you from an inheritance tax point of view. So previously, what people used to do with pensions, they used to take it out and need it to support their lifestyle. Nowadays, what would suggest is if you've got other money, you're always better off using the other money which is in your estate, because that money is going to be subject to inheritance tax. The money that you've put into a pension will be outside of your estate from an inheritance tax point of view. And under the current rules, this money can pass on to your children. It can go to your grandchildren in the future, and it can keep passing down the generations. One of the things that you can do is you can also make contributions to junior ISA for children or grandchildren. So the limit for them is £9,000 per year. You've got two different types. You can do a cash ISA for children, a junior cash ISA, or you can do a junior investment ISA. If the children are very young and the money is not going to be needed until they get to the age of 18 for university, then you may wish to think whether putting the money in a cash ISA is the best use of that money, because cash ISA, there's not going to be any growth, the rates are very low. If you've got a long period of time, you should really be looking at investment ISAs, so that, because we know that the cost of university education is going to be more expensive in the future. Cost of living goes up. At the moment, cost of living is it's really high. You'll see that with the energy prices going up. You'll see that with food bills going up. This is all to do with inflation, shortages. So there's a lot of factors taking place in the world where it's pushing up cost of living. You'll see it at the petrol station when you put petrol or diesel in your car. So cost of living is going up. So one of the things that you should consider doing is taking advantage of your capital gains tax allowance. So that's just over 12,300 at the moment. So one of the things you can do is you can sell some assets like in different tax years. So you could sell some before the 5th of April, you could sell some after the 6th of April. So you can put it into two different tax years. You then benefit from 2 lots of capital gains tax allowances. Where you have assets and you've got a gain and it's just in one person's name, you may wish to put it into both husband and wife's name. So then you've got 2 lots of allowances. If you can use 2 lots of allowances, that will end up helping to reduce the amount of capital gains tax that you end up paying. And the other thing that you can do, which is really useful, if you're expecting your income tax position to change from a high rate taxpayer paying 40% to a basic rate taxpayer paying 20%, or from a basic rate taxpayer to a nil rate taxpayer, then one of the things you could do is defer the sale of the asset until your income tax position changes. Now, this often happens when, for example, you retire, your income tax position will change. And therefore, it's beneficial for you to sell the asset when your income has dropped into a lower tax bracket. So again, that's helping you to maximize the efficiency of your planning when you're selling assets. You can take advantage of intersparse transfers. So you can transfer assets between a husband and wife to maximize your tax efficiency. And you should consider using annual gift allowance for this year and next. So we'll have a look at that shortly. Right, so let's have a look at the nil rate band, what they are, how they work. So currently for an individual, the nil rate band is £325,000. And for a couple, it's currently £650,000. So all individuals, all couples will have these allowances. And then something that's been introduced recently from the 6th of April 2020, well, it started in 6th of April 2017, but by the time we got to 6th of April 2020, the full main residence nil rate band has come into play. Now, for an individual, it's £175,000, and for a couple, they've got 2 lots of £175,000. So that means that their allowance available to them as a couple on the main residence nil rate band is £350,000. Now, of course, there are some rules that we need to take into account here. This applies to one property that has been your main residence at some point in time. But if you've had more than one property, you've lived in more than one property, you can nominate the one that you wish to use. You'd normally use the one with the highest value so that you can maximize the benefit of this allowance. Now, it's very important that this passes on death to direct descendants. Now, what we mean by direct descendants, we're talking about a child. So this could be a stepchild, it could be adopted, and it could be a foster child of the deceased and their lineal descendants. Now, the main residence nil rate band is fully transferable, just like the nil rate band. So if, for example, one spouse has passed away, all the assets have passed over to the surviving spouse, then that means the allowance will also transfer to the allowance. So if one person has passed away, the second person is still alive right now, then so far the £650,000 nil rate band will be available, and the additional £350,000 that I've referred to on this slide. So the total allowance will be £1 million. If the assets are above £1 million, then the inheritance tax will be payable at 40%. Now, one thing to be aware of, we've talked about passing on to direct descendants. Sometimes we've come across wills where it's going into a trust, it hasn't been set up correctly, it might be an old will. You've just got to get that checked, because if it's not been set up correctly, you could end up losing the main residence nil rate band, £350,000, if the assets are going into a trust and it's not the right type of trust as well. So here it talks about total nil rate bands. So here's a summary for the current tax year. For an individual, it's £500,000. This is made up of the 325,000 plus the main residence nil rate band of £175,000. For a couple, there's 2 lots of £500,000, 2 lots of both allowances. So the total allowance is 1 million. So let's have a look at the situation where we have assets over 2 million. So this is some extra rules that the government have. Now, this will apply. So this will reduce the main residence nil rate band. So for every £2 of assets you have above £2 million, then your main residence nil rate band will reduce by £1. So this means if your estate is worth 2.2 million, i.e. £200,000 over the value of 2 million, you divide it by 2, that means you're going to lose £100,000 worth of main residence nil rate band. So previously you had an allowance of £1 million, it's now come down to £900,000. As a result of this, it means that the tax is going to increase by £40,000. So where assets are close to 2 million, but you're not quite there, you certainly need to pay attention to it, because over time, it will creep up over £2 million because of inflation. If you're already above £2 million, then again, it's really important that you look at this area and you try and do some planning that will help you to keep your assets below £2 million, so that you don't end up losing the nil rate band, main residence nil rate band. What happens is, if your assets are worth 2.7 million, then you're going to lose the full £350,000 allowance. So that's going to be £140,000 extra tax. So that could be a lot of money that's just being given away needlessly, which we could have protected, we could have prevented. So there's some bits of planning that we can do there, which will really help you. This scenario, we're going to have a look at inheritance tax at 64% in just 3 generations. So what happens is, in this example, we're going to assume that the first generation have assets. So they've already got £1 million of assets up to the nil rate band. So they've got £1 million, they've got another £1 million in the other assets. And when we're talking assets, we're talking about everything you own. Main residence, buy-to-lets, jewelry, cash, stocks and shares, ISAs, premium bonds, everything is included in the value of the estate. Now, what happens, we know that when they pass away, so this first generation, we'll call them the grandparents. When they pass away, £400,000 is going to go to the taxman. So that means their children, the second generation, are going to receive £600,000. Now, there is a chance that this second generation may pass away 5 years after. If they pass away more than 5 years and 1 day or anything longer, then there's going to be a further 40% tax on this 600,000. Remember, this second generation, they've also got their allowances of, they're up to £1 million. This is the £600,000. It's getting taxed at 40% again, so £240,000 is gone in tax. By the time we get to third generation, which is the grandchildren, okay? Now, this £1 million that we started off with, it's now children. 64%, who's that going to? That's going to the taxman. So you can see that the taxman is the biggest beneficiary of this. You've worked hard, you've built all these assets for all these years, you've saved the money, you've looked after it. And in this scenario, the second generation passed away just 5 years. And if they pass away less than 5 years, then there's some protection, there's a reduced amount of tax. But after 5 years, which is not really a long time, anything after 5 years, they could be subject to inheritance tax again. So this is a big problem for a lot of families, a lot of generations. So what you're doing is you're paying tax on tax. There's going to be a lot of tax that's going, and that's really difficult to imagine that there's £1 million here, and by the time it goes to your grandchildren, it's gone down to £360,000. So of course, we need to make sure that we're paying attention to these scenarios. So here, what we're going to have a look at is some gifting exemptions. So these are some of the things that you could do that will help you to reduce the value of the estate. Now, unfortunately, these numbers are actually quite small because they were designed a long time ago by the government, by the HMRC. They haven't really been updated for a long time. So the value of these gifts is becoming less useful, but at the same time, you don't want to waste any allowances that you have available. So we should be looking to maximize any of these allowances possible. So you're allowed to give away small gifts to as many people as you like. The value can be £250, and the benefit is that you're going to save £100 inheritance tax straight away. You have what's called an annual gift allowance of £3,000. Now, this £3,000 is per person that's giving it away, not based on how many children you have. So let's say there's a husband and wife, then between you, you're allowed to give away £3,000 each. So that's £6,000. Whether that's one child, you give them £6,000, or you've got 3 children and you give them £2,000 each, the maximum that the parents can give away in this scenario is £6,000. You also have, if you haven't used last year's allowance of the annual gift, i.e. if you didn't make any gifts in the last tax year, then you can also go back to the previous tax year and use up another £6,000 again between the husband and wife. So total for last tax year and this tax year would be £12,000 for husband and wife. Now, really important that the small gifts and the annual gift exemptions don't get mixed up. So if you're giving this money to your children, you shouldn't give the small gifts, because then that's not what you're allowed to do. Now, the next gift that you can consider giving away is gifts in respect of weddings. So if your son, your daughter, or your grandchildren, if they are getting married, you can give away certain amounts of gifts where you're going to get inheritance tax savings straight away. So the parents can give away £5,000 each. So the mum and the dad can give away £5,000 each. So that's £10,000, and you can do it per child that you have that's getting married. The benefit to the children is, of course, that helps them because weddings are expensive. Cost of weddings is probably going up as well. And from the parents' point of view, it's also going to save you £2,000 of inheritance tax. So that's quite a nice saving. And the good thing with all of these allowances is that they're available immediately. There's no 7-year rule. There's nothing like that at all. The other thing that you can do is you can give away your surplus income. And the good thing is you can give away unlimited amounts of surplus income, and that will give you inheritance tax saving of 40%. And again, it's available immediately. So what we talk about is surplus income. We have to be careful that we're talking about income and not capital. So let's say, for example, you earn £50,000 per year. You spend £20,000 on cost of living. That means you could give away £30,000, which is your surplus income. Now, if you earn 50,000 and you're spending £50,000 and you give away £30,000, then that will be treated as it'll be treated as capital. So very, very, very important that we make the distinction between income and capital. Income is going to be outside of your estate straight away. There's no 7-year rule. Whereas with capital, if you don't spend the money, it builds up, it turns into capital, then you've got to wait seven years to get it outside of your estate. You can also give money to charity, and it's a 40% tax savings there. And again, it's going to be immediately outside of your estate. So where you have these allowances and you're not using them, certainly makes sense to start thinking about using some of these allowances. But at the same time, we have to be realistic that if the estate is sufficiently large, then giving these small amounts will not really make too much difference to the value of the estate, because cost of property is going up, cost of the value of properties is going up, value of investments will go up over time. So these things, although they're nice, we might need to look at a lot more planning to make sure we're bringing the value of your estate down. So here's a summary of some of the things that we've just mentioned so far on estate planning. You can give away £3,000. So the husband can give away 3,000, the wife can give away 3,000. So total between them, they can give away £6,000 to whoever they like. If you've got unused allowances from the previous year, you can do it at another £6,000. So that's £12,000 you can give away. So some options you could consider in terms of giving this money away. You could put money into junior ISA to contribute for the children. So you're helping them to build up a pot of money for their future. You could put money into a pension contribution for your grandchildren stroke your children. And it's quite nice, the numbers work out quite nicely. You could give away 2,880 as part of your allowance. You can put it into a pension for the grandchildren or for your children, and the government will add tax relief at 20%. So your 2,880 will turn into 3,600. So quite nice in the sense that you're saving the money from an inheritance tax point of view, plus you're getting a further uplift from the government. So rather than just giving them, sometimes it's not always good to just give them cash. Sometimes you might want to invest it, benefit from tax relief, and also that money will continue to grow in the future. Here it looks at inheritance tax gifts, the 7-year rule, and we're looking at taper relief. Now, sometimes people think that the taper relief applies straight away on all gifts. Between 3 and 7 years, the amount of tax starts going down. It doesn't actually work like that. So how it works with gifts, you have the nil rate band of £325,000. So let's say, for example, you give away £100,000. If, for example, you survive less than 7 years, that £100,000 will be treated, if you pass away, that will be treated as a failed gift. That means on the £100,000, your nil rate band will get reduced. Available nil rate band will go from £325,000 to £225,000 because you haven't survived 7 years. In order to benefit from taper relief, you've got to have given away the nil rate band first of all. So you've got to have given away £325,000. On that, if you don't survive 7 years, that would be treated as a failed gift. But if you survive the 7 years and you've given away a little bit more on top of the 325, let's say you've given away an extra £100,000, then that extra £100,000 will benefit from taper relief. So how the taper relief works is if you pass away within the first 3 years, there's no inheritance tax saving. You still pay inheritance tax at 40%. If you pass away between 3 and 4 years, the amount of tax gets reduced to 32%. Between 4 and 5 years, it gets reduced down to 24%. You can see between 6 and 7 years, it gets reduced down to 8%. And thereafter, it goes down to 0%. So what we're saying is, in some cases, it might be better to try and give away more of the assets from an earlier stage, so that you can get the £650,000 out of your estate. And then if you've got more money, you can give away another £650,000 every 7 years, because that's your nil rate band. So you can do multiple £650,000 every 7 years. And that's a powerful form of planning, because asset prices, if they continue to increase, you will still have a lot of assets, and you're reducing the value of the estate. So that's really, really helpful as well. So now we're looking at gifting during your lifetime. We'll have a look at arranging your estate tax efficiently. We're talking about wills and lasting power of attorney, and we're talking about covering any liability with whole of life insurance. So In terms of gifting during your lifetime, we've already mentioned that you've got some small numbers that you can use, and you should certainly use them, absolutely. But in order to bring the numbers down, we might need to make use of larger gifts to get the value outside of your estate. So what we're saying is, where possible, you should try and give away gifts during your lifetime. Of course, you might not want to give away everything. You still need to make sure that you've got enough income to be able to support your cost of living. So if you've got pensions, you've got buy-to-lets, or you've got other investments that will generate you income, then it's okay. If you've got enough income, you need to leave a little bit of capital just in case you need it for anything that's unforeseen. But then we should start offloading the assets. As you get older, you probably spend less money, so therefore you're building up more money in your bank accounts. Therefore, you can afford to start giving some of that away. So again, we've got to manage how you give the money away, when you give it away, what you give away. Yes, you want to give some away, but make sure you don't leave yourself without any money to look after yourself in the future, because if you give it to your children, there's no guarantee that it's going to be available when you need it. The money might be invested in property, investments, into a business, or they might have just spent it. So there's no guarantee it's going to be available. You need to think about arranging your estate tax efficiently. So we talk about wills and lasting power of attorney. It's amazing how many people I come across that don't have wills. It's about 65%, the national average of people don't have a will. Everybody knows it's important. Everybody knows that you should make a will. People think that the assets will automatically go to your surviving spouse. That's not always the case. It doesn't happen just that easily. And then you need to consider power of attorney. So where you haven't got wills, you should probably think about getting wills. Where you have them, maybe you made them 10 years ago, 15 years ago, you should review them, because there might be some changes in your circumstances. There might be some changes in your planning. So you need to make sure that the wills are reviewed, certainly every 5 years. If there hasn't been too many changes, maybe you could leave it a little bit longer, but always a good idea to review on a regular basis. Then we're talking about power of attorney. So this is lasting power of attorney. The old ones used to be enduring power of attorney. The new ones are called lasting power of attorney. There's two different types: property and financial, to do with bank accounts, property, money, that sort of thing. And the other one is to do with health and welfare, medication, treatment, that sort of thing. So where power of attorney is very helpful is if you lose mental capacity due to accident or illness. So what happens is you're unable to make your own decisions yourself. You haven't got the capacity. So what the lasting power of attorney allows you to do is it allows you to nominate someone who can step into your shoes. They can make decisions on your behalf. They can make certain decisions. If you don't have a power of attorney in place, and you lose ability to make decisions, and you no longer have mental capacity, then what will happen is the court of protection will be appointed. You have to fill in forms. You have to pay fees to access the money. It's quite a long, complicated process. You may be better off just doing the power of attorney. Now, with power of attorney, you can go to the Office of Public Guardians. You can download the forms from the website. They've got a really good, helpful website, helpful contact number, and it's something that I recommend everyone should do. You complete the documents, you send off your check, £82 per document. So if it's a husband and wife, there could be 4 documents. You send off 4 lots of £82, and then the Court of Protection will, the Office of Public Guardians will complete the necessary paperwork to ensure that those are set up. Now we're looking at covering any liability with whole of life insurance. So first of all, we have to consider that sometimes it might not be always possible. So previously we talked about giving assets away. It might not be possible because 1, you might need access to those assets. 2, they're giving you an income that you need to support your lifestyle. Three, you know that once you've given those assets away, you've no longer got them. And if you invest it, if the money is invested, if you try and give it away to your children, then there could be some capital gains tax complications. So you need to be aware of all of those things. So there might be reasons why you may not wish to, or you may not be able to give away the assets. Remember, you need to keep some for yourself. Some you can give away, and some there might be some tax issues, tax complications for you to consider. So here, what we look at is a different type of approach, a different type of solution. Here we're looking at using a joint life, second death, whole of life policy, which is a insurance policy which you use to pay the inheritance tax. So in this example, we look at joint life, second death, whole of life, which pays out when the second person passes away. I've looked at a sum assured of £100,000, and we're saying that they're both non-smokers and they're both in good health. If they're smokers or their health is not as good, then of course the premiums will be more expensive. So if they're both 45, then the premiums per month would be £105.14 per month, and the age they would need to live to before the amount they've paid in equals the amount of 100,000, i.e. the payout. They would have to live to the age of 124. Now, if they're a little bit older, they're 55, then yes, the premium is going to be more expensive because the risk is higher. The premium is £143.21, and before they get to a break, they wouldn't get to a break-even point unless they live to 113. If they're a little bit later, they're 65 years old, it's going to cost £207.63, and the break-even point is 105. And if they're 75, then the cost is going to be, you can see that the cost goes up quite rapidly. It's £322.56, and their point is 100. Now, average life expectancy is 85, 86, 87. It's based on a number of different factors, but at the moment, life expectancy is increasing because of medical science is getting better. We're able to detect things earlier. There's better treatments. And also people are a lot more aware of nutrition, diet, lifestyle, all of these things people are thinking about, they're paying attention to. Maybe for the last 2 years, they've gone on different Zooms and learned about these sorts of things to help improve their lifestyle. So certainly life expectancy is increasing for a number of factors. Now, that's the average life expectancy. That means that some people will live longer, and some people will unfortunately not get to those figures. So what we're saying is you want to plan as much as you can. You want to have different types of planning. The thing I would say is the value of the £100,000 in the future is going to be less because of inflation, cost of living. We know that £100,000 10 years ago was a lot more. You know that you could buy a lot more with 100,000. Now, £100,000, the value is less. Further 10, 20 years, the value is again going to diminish. It's still £100,000, but what you can buy will be less. So that also means that the value of these premiums, the actual value of the premium, £105 in the future is different to £105 now. £105 now is more valuable. £105 in the future is less valuable because the purchasing power has been reduced. So yeah, these life policies, it's a good solution. You can use it where you haven't got a inheritance tax liability, but you want to leave some money to the children. That's absolutely fine. So here we're talking about trust. So before we start looking at trust, it's useful to gain an understanding of what a trust is, what it does, and who are the parties that are involved in a trust. So a trust allows a third party, i.e. a trustee, normally a family member, to hold the assets, and they will hold it on behalf of the beneficiary or the beneficiaries. Now, the trustees and the beneficiaries can be the same people. It's a great way that allows you to transfer wealth from generation to generation. And it also allows you to arrange your estate tax efficiently. So on the previous slide, I mentioned that you need to give away larger amounts, but you might not necessarily want the children to have it straight away. You might be worried about divorce. You might be worried about bankruptcy. So if you put it into trust, it gives you a lot of protection. And then that problem that I mentioned about the 64% inheritance tax, if you put it into a trust, it's very beneficial because it ensures that 64% doesn't get paid in tax. So the 64% was where the second generation passed away just 5 years after the first generation. So if we put the money into a trust, you've got control. So that's really important. The children can't just go and blow your hard-earned money on a yellow sports car, a yellow Lamborghini, or a yellow Porsche. Okay. It gives you control. It gives you peace of mind and protection. If there's any divorce, any bankruptcy, then the money's in the trust. And if there's any scenario taking place like that, for protection, you leave the money in the trust. You don't take the money out from the trust and put it into the estate to create more problems. So we'll have a look at some of the different types of trust that we use to help our clients with their inheritance tax planning. So the first one is what we call the gift plan. So with the gift plan, we're talking about giving away surplus capital. So when you give away surplus capital, the money will be outside of your estate for inheritance tax purposes, providing you survive 7 years. So this might be money that you're thinking, look, this is extra money. We're not planning on using this extra money. It's not earning any rate of return in the bank account. If you've got it in an ISA, you're going to get hit by 40%, yet you're only earning maybe 1%. Okay, so this is good because any annual allowances, if you're using your annual allowance as part of the gifting, then those annual allowances, when you put it into a trust, the annual allowance of £3,000 that I've mentioned so far, that will fall outside of your estate straight away. Now, the good thing is with the money is invested. Hopefully over a long period of time, the value of the investment is going to grow. We want the investment to grow. So if the investment grows, the good thing from an inheritance tax point of view, let's say you put in £100,000 and after 5 years, it's grown to £140,000. That £40,000, the profit, that's going to fall outside of the estate. So that's not subject to inheritance tax. The profit will fall outside of the estate immediately. So the £100,000 will stay in the estate. The capital will stay in the estate for 7 years. The profit, the growth will fall outside the estate. The trust documentation is provided. So it actually says here, withdrawals within the allowance may be provided without immediate liability to income tax. Of course, you're not allowed to take out the money yourself because there are rules around the gift with reservation of benefits. And we put all the trust, that we put all the paperwork in place. There's no annual returns, there's no self-assessments. From a paperwork point of view, it's really easy to administer as well. The only thing you've got to do at the beginning is register the trust, because the HMRC need to know who the parties are. And then we're having a look at the main uses that are available for these types of trusts. So for the gift plan, it allows you to make use of the inheritance tax exemptions and reliefs. So, for example, those small numbers, annual allowance, you can put it into a trust. You can put in, if you've got disposable income, which you don't need, you can put that into the trust. If you want to use up your £325,000 Nil Rate Band, you can put that into the trust. And the good thing with that is, after 7 years, you've got another £325,000 for an individual. You can use this money if you're thinking about for cost of education for your children or your grandchildren in the future. Then obviously we know that cost of education is going to be quite expensive. So what we're trying to do is we're trying to invest the money, get the money to grow, and then use that money to fund the cost of education. So that's really helpful as well. So key thing is it allows you to plan and prepare for these costs. It allows you to help your grandchildren or your children, and it allows you to also protect the money from tax as well. So it's really powerful. The proceeds of the gift plan can be received by your beneficiaries, and at the same time there's no delay because of probate at the point of death. And then where a discretionary trust is used, funds in the trust will not form part of the beneficiary's estate for inheritance tax purposes. So this relates to the problem that I mentioned, the 64% or 640,000 pound cash that got wiped out. Because it's a discretionary trust, that means that no beneficiary is 100% entitled to the money. So the beneficiaries can change. Therefore, you won't have that problem that I mentioned before. Now we look at the discounted gift plan. So this is slightly different. This allows you to give away your capital, and it allows you to retain an income for the rest of your life. It gives you an immediate reduction. So there's something called a discount, and your liability, your inheritance tax liability will be reduced straight away based on the HMRC formula for the discount. And what it provides you is it allows you to give the capital away. It allows you to retain an income. It's really a return of capital, but because it's a return of capital, it's non-taxable income. So you can get it, you can have, there's no immediate tax liability. So that's all fine. Inheritance tax on your investment, providing, so as long as you survive 7 years, the whole value of this investment will be outside of your estate straight away after 7 years. So some of it will be outside straight away, depending on what the value of the discount is, and the balance of the money will be outside of the estate after 7 years within the discounted gift plan. Here it tells you again, any future growth is going to be immediately outside of your estate for inheritance tax purposes, and there are potential immediate tax savings, which the next table will show you. So in this scenario, you're giving away £250,000. You're entitled to 4% withdrawal. So when you give away this £250,000, and it's going to depend on what your age is. So if you're age 60, that's where you get the maximum benefit. The value of the discount will be £137,000, which will fall outside of your estate straight away. So that means it's going to save you £54,800 off inheritance tax. If you're 70 years old, then it's going to save you, the discount is a little bit lower, 107,000, and the tax saving is going to be 42,800. If you're 75 years old, the tax saving is going to be 36,280. And if you're 80 years old, the value of the discount has dropped to 56,000 because there's less years that you're going to live. So therefore, the value of the discount drops. That means that the tax saving, I mean, it's still worthwhile. You're still saving £22,640 immediately. So really good form of planning where it allows you to give away capital, but allows you to retain access to your income, because you might need to cover your expenses, cost of living, all of those things, holidays. You can use the discounted gift plan to allow you to give away capital, still keep an income, and not break any gift with reservation of benefits. So here, what we talk about is the loan plan. So how that works is, you're not sure about just giving away the capital, or like in the previous two examples I've mentioned, you're making a gift of the future growth. So you still always will have access to your capital, but what you're saying in this scenario is the growth, the profit, you don't need that. So you've got access to capital, but no access to the growth. It helps you to reduce your inheritance tax liability. It provides full access to your original capital. So it's a really flexible way. Now, if you've put in £100,000 into a loan plan, that money is still going to be in your estate. So you take it out, you spend it. As you take it out and spend it, that will then drop outside of your estate. So the benefits are that, of course, the investment growth is immediately outside of your estate. You retain the ability to recall the outstanding loan. So this is where you need flexibility, where you need the money back. You've always got it. You haven't given it away. There is no inheritance tax payable on establishing the trust, and investing into a trustee bond or international trustee bond. Again, it reduces paperwork to the minimum. So nice and straightforward from that point of view. So this allows you to keep access to capital, but reduce your IHT liability, because you're giving away the growth, but you've got access to your money. That's why it's called a loan. You can elect to receive regular loan repayments. If you need additional money to supplement your income, to cover your expenses, this will allow you. The plan can provide a flexible platform, and from there we can do further inheritance tax planning. So you might think about starting it early. You think, okay, I'm still young. I don't want to give away all the money. I might need it. Circumstances might change. Then you might start off with a loan plan. As you get older, you might progress and say, look, okay, I didn't need this money. I'll now put it into the gift plan or the discounted gift plan. So you can do that. A couple of other solutions that are worth mentioning. Here we're talking about the enterprise investment scheme. So this might be suitable where you medically your health is not good, you might not survive 7 years. You're elderly, you might not survive 7 years, or for medical reasons, you might not be able to get life insurance. So you might wish to consider things like enterprise investment scheme, where you're investing in smaller companies, startup type companies. The risk is, of course, going to be higher because you're investing in smaller companies, but they do give you, the government does give you considerable tax reliefs in terms of these types of investments. So you can get income tax relief at 30%. So you can only get tax back income tax that you've paid. So where you've got some restrictions on pensions because of earnings, or you might have rental income, which you can't use for pension, this allows you to claim back your income tax. Capital gains tax deferral, so it allows you to go back 3 years through the use of an inheritance tax scheme. So if you sold an asset within the last 3 years, you've got a gain, then it allows you to defer the capital gain. Now, if you take the money out of the investment, then obviously the capital gain will be payable. If you hold the investment till the point of death, then the capital gains tax will get wiped out because there's no capital gains tax at the point of death. And there's also inheritance tax savings after 3 years by investing into a enterprise investment scheme. The scheme becomes qualifying as business asset or business relief, and the money will be outside of the estate. So there are multiple tax benefits with enterprise investment schemes, but what we would say is you've got to look at the whole picture. Yes, the tax benefits are good, but you've got to look at the level of risk, the type of companies that they invest in, and this may be suitable for some investors, but it may not be suitable for all investors. So if you've never done investments, it's not going to be suitable. If you only like low risk investments, then this is not going to be suitable for you. If you think, okay, I need to get it done within a short period of time, then this might be suitable. If you're happy with a higher level of risk, then that's fine. And what we do is the fund manager will put the money into maybe 10 or 15, 20 different companies. Now, some of these companies may go out of business. Some of them will do really well. What we do to further reduce the risk is invest it with different fund managers as well. And then here, what we've got is business relief. So the blue bars are showing you the probability of the surviving 7 years. So you can see the older you become, the older you are, the less your chances are of surviving 7 years. Whereas here, the gray bars are showing you what's the chance of surviving two years. So if you're 80 years old or 85, even 90, you've got a very good chance of surviving 2 years. So if you survive 2 years, this investment will be outside of your estate from an inheritance tax point of view. You have to hold the investment for 2 years and hold it at the point of death. If you do that, the investment will become qualifying and will not be part of your estate from an inheritance tax point of view. Again, you have to consider the different types of risk involved. They are a bit more riskier than other types of investments, but less risky than the enterprise investment scheme. So again, what we're saying is we're recommending different strategies for different types of planning that we need to look at. So can be a really useful solution where people haven't got 7 years, they can't get life insurance because of medical conditions. But if there's a good chance that they'll survive 2 years, then that will be outside their estate within 2 years. There is other planning that we can do with these business relief planning products. Some of them come with built-in life cover. So let's say, for example, you invest £100,000, maybe you don't survive 2 years, but because they come with built-in life insurance, that means that life insurance, built-in life insurance, will cover the cost of the tax on the £100,000. So the life insurance would be for £40,000. So how they do it is they charge you some additional premium, which covers the cost of life insurance. So really good where you think, okay, you've left it late, you're really worried, then this could be, again, another solution. So yeah, there's plenty of different solutions out there. Just depends on a variety of factors. So we're now looking at main residence property planning. And lots of my clients or lots of people tell me, So what I'll do is I'll just give my residential property away. We'll give it to the children. We'll carry on living in the property, and my inheritance tax planning is solved. Unfortunately, it's not that straightforward. The revenue want their money. The revenue will get their money. So what happens in this scenario, where people have said they've done that, the fact is, if you look at the HMRC guidance, that will not work. Now, there's two scenarios that are available. The first scenario is you give the property away, the children live with you. That's fine as long as that's the intention. Things to consider is that you need to you need to be both contributing to the running cost of the household in the percentage of the shares that you own. Things to consider with this is that the children might not always live with you. The children have shares. So if they get the wrong partner, that could mean that there's a risk to your property. The children could actually force the sale of the property because they are the owners of the property because you've given them the shares. So the property that you had worked hard to pay off, and then you're trying to save the inheritance tax, there could be these additional complications. So you've got to consider that carefully. And the second scenario is you give the money away and the children don't live with you. Now, what you need to do in this situation to make sure that everything has been done correctly is you need to pay a market rate of rent for the property. So there's no family discount, there's no family rate. It has to be what the commercial value is, i.e. how much would this sort of property, how much would it expect to rent for? So if you've given away 50% of the shares of the property, you have to then pay 50% of the total rental income to your children. Your children, because it's rental income, they'll then have to pay income tax. Like any buy-to-let income or any rental income, you have to pay income tax. So it's quite an expensive way of doing it, because if they're 20% taxpayers or 40% taxpayers, it suddenly looks less attractive. One, you've got to pay this rent to them, and then they've got to pay, because it's income, they've got to pay tax. So we generally find that is not, it doesn't really work. Doesn't look efficient from that point of view. So that then brings us up to inheritance tax options. We've gone through lots of different scenarios. Now we're looking at simplifying some of the options. First of all, we said that you can put money into a trust, which will help you to give away the larger amounts. It'll give you the benefits of the protection and the safeguards that the trust will offer you. So that's a really good solution. You could look at a whole of life cover to cover the tax that's going to be due because assets are going to increase. You could also look, if the whole of life cover is expensive, you can look at life cover to the age of 90, which means that really you should try and give away all the assets by age 83, and then you've got 7 years left after that. If you survive 7 years, if you survive more than 7 years, great, your planning will work. If you survive less than 7 years, you've got the protection of the life policy. So again, that would work as well. Then the next option you could consider, whilst we talk about life cover, if you're giving away the gifts, you might want to look at life cover for 7 years, because the time that you need to survive is 7 years. If you survive 7 years, great, your planning works. If you don't survive 7 years, then the life policy will protect. So what we're saying is we want to be 100% certain, because life is uncertain, life is unpredictable. We need to know that the planning that we're recommending is going to do what you want it to do. Then you can look at tax efficient investments, business relief, the enterprise investment schemes that I've just mentioned so far. And then the fourth one, which is always, I think it's actually difficult. You could spend or give your money away. Well, you're not going to spend your money unnecessarily on things that you don't need. And when you give your money away, if the property price, if whatever you do, if the property prices keep increasing, that means the value of your estate is going to keep increasing. So you might not just be able to spend or give it all away, because you might need to keep it. There might be tax considerations, and you're not sure what the future is. So what we're saying is you have to look at the different types of options. It's different for every single person, their scenario, and that's where the advice we can provide can really help to allow you to focus on, because I've talked about lots of things. I mean, I could carry on for longer, but at the same time, I don't want to overload you with too much information, make it more complicated. I've tried to keep it as straightforward as possible. And then in summary, so just to summarize everything that we've discussed before we move on to questions and answers. So we talked about the concerns that everyday people have, where you will relate to those concerns. It's always the same concerns that I mentioned at the beginning. The initial planning ideas, we talked about ISAs are not tax efficient from a income tax, from a inheritance tax point of view. Of course, they're tax efficient from income tax and from a capital gains tax point of view. We talked about how the changes in pensions means that pensions is a really attractive option in terms of putting money into pensions to help save tax as well. We talked about capital gains, the things that you can do with assets. We talked about junior ISAs. So those are some of the other things that you can do. Nil rate bands, 325 for an individual, 650 for a couple. Main residence nil rate band, 175 for an individual, 350 for a couple. Total allowance is 1 million for a couple, 500 for individual. We mentioned the problem of assets over £2 million. The main residence nil rate band gets reduced, and when the main residence nil rate band gets reduced, because the assets are over £2 million, it increases the amount of tax you end up paying. So what we need to do is try and look at ways of bringing you back below £2 million. Sometimes it's possible, sometimes it's not really possible, depending on the makeup and what the estate is. We have to be aware of the inheritance tax at 64%. This is where the second generation passed away just 5 years after the first generation. The third generation from the million, they received 36%, and 64% went to a tax man. So that's going to be a big problem. That is already a big problem at the moment, because you're paying tax on top of tax. We talked about the gifting exemptions, what you're allowed to give away, the benefits you get, and that you should try and use the exemptions where possible. Talked about 7-year rule, taper relief, failed gifts. So the taper relief applies after you've used up the nil rate band. We talked about the importance of wills and power of attorney. If you haven't got it, you should do. If you've got it, you should review it. Then we talked about the different trusts, giving away capital plus keeping the income. Plus we talked about having the flexibility that the loan plan gives you, which is access to your capital just in case you need it. Then we talked about life insurance, where life insurance could be a good solution, might be beneficial where there's going to be tax liabilities, or you want to hold on to the assets because the assets are going up and they're giving you a nice secure income, which you can cover your cost of expenditure. Then we talked about other types of planning, enterprise investment scheme, business relief. What you can do around main residence is never as straightforward as people think. And then here it tells you, of course, the value of any investments can go up and down. So that's everything on the presentation. I've put my contact details on here. If you have any questions, I'll be happy to go through them in the chat. If they're a bit personal and you don't want to, or you don't feel comfortable in discussing in front of everyone, then feel free to drop me an email or contact me on the number, and I'll be able to advise you what you need to do. So key thing is nothing for you to worry about. I'm here to help you. If you have any questions, feel free to pick up the phone. Certainly. And now, yeah, we're ready for questions.
Thank you very much, Dipesh bhai. Like you said, it's not as simple. Oh, before you take that, that's okay. The last one, if you want to keep it for a few.
Oh, okay, let me share the screen again.
Okay. I've taken a photo as well, just so that if anybody needs to contact Dipesh bhai, the number and email is there. Please, a humble request that do not call. Always message to check if Dipesh bhai is free and available to speak to you. You can always message and send a short message what you want to discuss. બધાને નમ્ર વિનંતી કે આ નંબર જે દેખાય એના પર તમે દિપેશભાઈને નાનો મેસેજ મોકલજો. એમને ફોન નહીં કરતા, એ દિવસના કામ કરતા હોય, બિઝી હોય. સો પ્લીઝ એક મેસેજ મોકલજો જેથી કરીને તમારું પ્રશ્નને લઈ અને દિપેશભાઈ તમને જવાબ આપી શકે. અને દિપેશભાઈ કીધું એમ સીધું સરળ એકદમ નથી, ઘણું બધું કોમ્પ્લિકેશન્સ છે, માટે બધાને જુદું જુદું લાગતું હોય. તમને એમ લાગે કે આ તમારા કામનું છે અને વારે વારે જોજો. યુટ્યુબ ઉપર છે, so તમે ફરી જોઈને તમને વધારે. I think we'll take the share screen away. It's blank at the moment. So that's okay. We've got the number anyway. જેને નંબર જોશે તો આપણે નંબર આપીશું, કાંઈ વાંધો નહીં. થોડા જ ક્વેશ્ચન્સ છે, થોડા પ્રશ્નો છે, એ આપણે લઈ લેશું. એટલે દીપેશભાઈ will try his level best to answer your questions, but if at all, if he thinks it's not as simple as you think, okay, you can always get in touch with him via their contact number or email again. So we'll go right at the top. First question, okay. If you, this is from Harish Bhai. If you have given away your estate 7 years before your death, is there no inheritance tax of 40%?
So if you've given away your estate and you're less than £1 million, then, and you've survived 7 years, then there's no inheritance tax.
Harish Bhai, I hope that answers your question. Yeah. Next one is, throw some light on discounted gift trust to enjoy 5% tax-free withdrawal, please. Thanking in advance.
Yeah. So it works is you put the money into a investment bond. Investment bond trust that we allow you to take. Now with that 4%, the value, of course, the value of the investment will go up, but the 4% is fixed. It's treated as a return of capital, and because it's a return of capital, there's no day of capital.
Sorry, Dipesh, but I think there's a connectivity problem, so we'll just wait for him to, hopefully he can reconnect again. I know, thank you for all your questions. We will, as soon as Dipesh Bhai's internet is okay, we'll get back to the questions. But thank you for all those who have put their questions down on the chat. તમે જે કોઈ પ્રશ્ન લખ્યા છે, thank you very much. હજુ પણ કોઈને હોય પ્રશ્ન, હજુ સમય છે, તમે ચેટમાં લખી શકો છો. ચેટમાં ના ફાવે તો ફોનમાં પણ વોટ્સએપમાં મોકલી શકો છો. I think Dipesh Bhai is logged out and he will come back in a minute. So we will have to just wait until he comes back. પાછું આપણે કહી દઈએ કે આ બધું જે આપણે સાંભળીએ છીએ, આજેનું આ પ્રોગ્રામ છે એ યુટ્યુબ પર છે. તો જેને પણ એવું લાગે કે તકલીફ આમાં મને સમજાતું નથી, અમને આ સ્લાઇડ શો જોઈએ છે, કોઈએ પૂછ્યું છે, તેઓ યુટ્યુબ RPM લાઈવ ઇવેન્ટ્સ ને યુટ્યુબમાં જશે તો તેઓને પાછું એ જોવા માટે તમે જેમ 2-3 વખત જોશો તો તમને વધારે સમજાશે, થોડું પિક્ચર ક્લિયર થશે. ઇન ધ સેન્સ કે આપણને અત્યારે 1 કલાક દીપેશભાઈ કન્ટિન્યુઅસ બોલતા રહ્યા હતા. આપણા મગજમાં આપણે જેટલું લઈ શકીએ એટલું લેવાની કોશિશ કરી છે, પણ તમારા પોતાના સમયે, તમારી પોતાની અનુકૂળતાએ યુટ્યુબ પર પાછું ને પાછું જોતા રહેજો, પોઝ કરજો, રિવાઇન્ડ કરજો, ના સમજાય એ લખી લેજો. અને પછી દીપેશભાઈનો નંબર છે અને દીપેશભાઈનો ઈમેલ એડ્રેસ પણ છે. તમને એવું લાગે કે એમાં કોઈ ક્વેશ્ચન છે જે તમારી જિંદગીને બહુ જ કામનો છે, અગત્યનો છે, તો જરૂરથી તમે એ મેસેજ કરી અને દીપેશભાઈ સાથે ડિસ્કસ કરી શકો છો. We will try and see કે આપણે જોશું જો દીપેશભાઈ પાછા લોગિન થઈ શકાય કે નથી, which I think he's having a little bit of internet problem, but that's okay. હજુ પણ કોઈને હોય પ્રશ્ન તો જરૂરથી તમે લખી શકો છો. We'll wait for another 5-10 minutes. That's not a problem at all. We will not go read out any questions until Dipesh Bhai is logged on. Sudhima, we can just okay, that's fine. This is what I mean. તમને એવું લાગે કે કાંઈ question છે, you cannot write it on the chat, that's okay. Send a WhatsApp message. બોલીને મોકલવું હોય તો બોલીને મોકલો, લખીને મોકલવું હોય તો લખીને મોકલો, જે અમે પછી દીપેશભાઈને આપણે પૂછી શકશું. We do apologize. Like we say, technical issues is beyond our control. દીપેશભાઈને ત્યાં કદાચ કાંઈ પ્રોબ્લેમ થયો લાગે છે internet connection. It happens. Not to worry. We will try and get. Oh yeah, he's logging back on now. No message I was, so fingers crossed. We should have Dipesh Bhai logged on as soon as we can. Let's see. In the meantime, પાછું યાદ અપાવી દઈએ કે આવતીકાલે આપણે મંથલી ભજન્સ છે અને સવારે પણ જો ફ્રી જે કોઈ જોડાઈ શકે તો બાલ મંદિરના હનુમાન ચાલીસામાં જોડાજો, જેથી કરી અને આપણો જે શનિ રવિ છે આપણું વીકેન્ડ છે, આપણે શરૂઆત સરસ રીતે હનુમાન ચાલીસા ઘરમાં ઘરનું વાતાવરણ પ્યોર કરી દે છે દર શનિવારે. તો જરૂરથી 9 વાગે હશે તો એમાં 9 વાગે જોડાજો. અને સાંજના બાળકો એમના ભજન ગાશે, તેઓ પોતાનું આર્ટ વર્ક પણ આપણી સાથે શેર કરે છે. સો જોઈન થઈ અને તેઓને આપણે પ્રોત્સાહન આપવાનું છે. સો પ્લીઝ ડુ ધેટ ટુમોરો 7 o'clock. And then Sunday is bingo and antakshari. So we look forward to that as well. And also, like Paresh said, enjoy the sunny weekend and sunny few days to come. But make sure you stay hydrated. પાણી સાથે જ રાખજો, પાણીની બોટલ અને પીતા રહેજો. I think he's still out. Is that him? Yes, we've got Dipesh Bhai in the house. So let's see. We'll make Dipesh Bhai. Yeah, we need to unmute. I think Dipesh Bhai is here. Yes, Dipesh Bhai. Can you make him co-host, please? I've unmuted him. So let's see. Dipesh. Oh, I hope I have not unmuted someone else. Wait.
Wait. Hello.
There you are.
I'm back. Sorry, I lost the connection there.
That's fine. That's what we said. Make him co-host.
Oh.
Okay, so
Just
let's
give you a highlight back.
start. We'll start reading the questions again.
Okay.
ત્યાંથી જ આપણું second question થી જ we lost your connectivity. So it was throw some light on discounted gift trust to enjoy 5% tax-free withdrawal from Chandrakant Bhai.
So how it works is you put the money into the bond, which goes into the trust. The money in the bond is invested. The bond allows you to take the withdrawals. We allow a withdrawal of 4%. It's non-taxable because it's a return of capital. It's not treated as income. So 4% is what we allow. Yeah, that's how that works.
Okay. Hope that answers your question as well, Chandrakant Bhai. Next one is, how long does it take to set up a property trust? SEAPT and APT. And how much does it cost to set up SEAPT and APT?
So I'm not familiar with APT or those abbreviations, but if you're setting up a trust with where you're putting property in, then normally that's something a solicitor or a tax advisor can help you with. We don't get involved in setting up those types of trusts, but when you do set up those types of trusts, you've got to be sure that you're not going to need the rental income, because the rental income will belong to the trust and that will go to the beneficiaries. If you're setting up the trust and you're putting the property in, you can't have the rental income because that would be breaking the gift with reservation rules.
Okay.
And how much does it cost? I would say it's going to be a few £1,000, depending on the complexity and who you speak to.
Okay, thank you very much. Next question is, does value of one's life insurance count in your estate?
If you haven't put it into a trust, so lots of times we come across cases where clients they've taken out a life policy, they've not put it into trust. So when they pass away, that money that they've got the life policy for, that will, if the life policy is £100,000, when they pass away, the £100,000 will come into the estate, and that will then be subject to inheritance tax. What we recommend is that the life policies go into trust. If they've been set up correctly in trust, then they will not form part of the estate from a inheritance tax point of view.
Thank you. That's Mayuri Nakar. Next one is Ziren saying your 64% example. I thought the 40% tax is only applied after the 325k threshold, not on the entire value of the estate.
Yeah, it's on the value of after the allowances. So I did say that they've got £1 million already. This is the surplus money. So they had £1 million that used up the allowance. They had another £1 million.
Okay, we've got a few questions from Suresh Bhai. That makes it good. So that may answer a lot of other people's questions as well. Obviously, Dipesh Bhai, Jai Jinendra, please can you describe what type of charities are included in the gifts? That's the number one question. So we'll take
any registered charity. So for example, British Heart Foundation, Macmillan Cancer, I think, Shishikunj would be a registered charity. Oshwal, Navnat, all of these types of associations will be registered charities. Patel communities, most of them are going to be a registered charity. So, the key thing would be just to ask them if they're a registered charity, but it has to be a registered charity.
Okay. Also, amount spent on children's wedding ceremonies, like for example, reception, etc. Does that fall under gifts? But you answered that, right?
Yeah, well, it could fall under your gift from surplus income if you can demonstrate that was from your surplus income. Otherwise, it's going to be from your capital. So if it's from your capital, you need to survive 7 years. Anything above the £3,000 allowance.
Okay, and one more. Are there any tax implications if we help our children to get on the property ladder?
So, for example, you give them £100,000 as a gift, then there's no tax implications on that. You're allowed to give them £100,000 or whatever the amount is you wish to give them as a gift. Of course, like with any gift, you have to survive 7 years. The first £3,000 would be exempt if you haven't already used up your allowance already. If you have, then you have to survive 7 years. But no, there's no taxation implication from that point of view.
So would the temples and churches, do they come under?
Temples, churches, most of them will be registered charities. Yeah.
Yes, thank you very much. So
they need to be registered with the Charities Commissions.
Yeah.
Correct.
Okay, thank you for those questions, Suresh Bhai. I hope you got some answer from them. So next one is Prakash by Makwana. Example, if we have put the 350,000, I think I'm reading the zeros right, yeah, in offshore trust after 7 years, amount is 50,000 or 500,000, whatever. Does all amount become tax-free, IHT free?
If you put it into a offshore trust, you survive 7 years. As long as you've survived 7 years, that money is going to be outside of the estate. And that's why we always say, try and do this planning as soon as possible, because we don't know who's going to survive 7 years, how long you're going to survive. If you do it earlier, you've got a better chance of surviving 7 years.
Okay, and Ilaben is asking, can we have Dipesh Bhai's number? Yes, it was on the screen, but we'll write it again. We'll put it on the chat.
Shall I put it in the chat?
Please. Is that it, Anish?
Yeah, that's all the questions.
Let me just check again on here. Again, for everybody's just information that, somebody was saying, can we have this PowerPoint slides? It's all on YouTube. You can go on RPM Live Events YouTube channel and you will put in today's date. You will see as soon as you put in inheritance tax, you may come up with two, today's and last year's. So you can re-watch them again and get more clearer picture of all your questions. I've got one on my WhatsApp. Can you give away your rental property and pay no tax? Does this £1 million only for residential property where we live?
So a couple of questions in there. The £1 million covers all assets, but to get the full £1 million allowance, you've got to have a residential property. So let's say, for example, you never owned a residential property, then the maximum allowance you're going to have is £650,000. Let's say if you give away your rental properties, if you give away the rental property, then the rental income.
I thought he was putting the number on there. I think Dipesh is having issues with the internet again. We will get answer to that question, and somehow I will WhatsApp you back. Last one. Thank you very much, Suresh Bhai, for your thank you message as well. Suresh Bhai and Chanda Ben. Yeah. So thank you for that message. I think Dipesh Bhai's internet is gone again. So if you want to, screen is frozen. How come it keeps coming back on? Just pin us, so it will come back. There you go. I'm going to pin you. Spotlight. Yeah. So we will wait for a few more minutes for Dipesh Bhai to come. But if you have raised hand, please put your question in the chat. Tame jo hath upar kairo hoy. Oh, he's back. Yes, I'm back. He's back. I'm going to repeat that last question again. We need to unmute him. Just 1 second, Dipesh Bhai. I know, like I said, this is beyond our control. Technology is something. Unmute. Yeah, are you unmuted?
He's frozen again.
Oh. Internet is playing tricks with us today. But let's see. I think, sorry, Dipesh Bhai.
Unmute.
Just 1 second. Dipesh Bhai, no, he's unmuted. Tame unmute. Yeah, can you say?
I can hear.
Okay, I'll repeat that question. You know the question about can you give away your rental property and pay no tax? Does this £1 million only for residential property where we live?
Oh, okay. So the £1 million allowance covers all assets, but the £1 million allowance is only available to you if you've had a residential property. So if you never had a residential property, if you never owned one, then the limit available to you is £650,000 of allowance. In terms of giving away rental properties, you can give away rental properties. You can't have any of the income because that would break the gift with reservation of benefits, and you're not allowed to do that. So you've got to be sure that you're not going to need the income and that you can afford to give away the property. You can't give away the property and keep the income, the rental income.
Yes, so far that's it. I think we've covered. Okay, one more question. I hope that helps you, Nima Bin. Is that? Yeah, good. Last one. Harish Bhai has just sent one more. If I have put lots of money in my pension, if I die earlier than expected, is there any benefit to my next of kin from the pension?
Yeah, so if you die before the age of 75, then the money will be tax-free to your beneficiaries. They can take it either as income or a lump sum. If you die after the age of 75, then the money, if they take it as income or if they take it as capital, will be taxed at their marginal rate of income tax. The good thing is with pensions, it can pass on from generation to generation. So really efficient way of passing money down the generations.
Okay, I think that has Harish, I hope that answers your question. I'm just going to. You haven't put your number down, ne?
Oh, I thought I did, but it might have just got lost.
Okay, Rohini, do that again. But like you said, it's all on YouTube, so you can scroll along on YouTube. You see Dipesh Bhai's number on YouTube as well. I hope that's okay.
Oh, there it is. He's put everything on the chat. જેને કોઈને જોઈતો હોય chatમાં છેલ્લો મેસેજ છે દીપેશભાઈ તરફથી એમની બધી ડિટેલ્સ છે, ટેલિફોન નંબર છે, મોબાઈલ નંબર છે, વેબસાઇટ છે. Only thing is email is not there, but તમે કાંઈ પણ હોય તો મેસેજ કરજો. પહેલું વસ્તુ મેસેજ કરી અને દીપેશભાઈને તમે તમારો ક્વેશ્ચન હોય એ મૂકશો, એટલે પછી એની અનુકૂળતાએ સમયને માન આપણે આપવું પડે. એ કામ કરતા હોય જ્યારે એને સમય હશે તો જરૂરથી એ તમારી પાસે તમને જવાબ આપશે. દીપેશભાઈ ઈમેલ પણ લખ્યું છે, સો તમારે જે રીતે ફાવતું હોય, ફોનમાં મેસેજ કરવાનું ફાવતું હોય, ઈમેલ લખવાનું ફાવતું હોય, જે રીતે તમને ફાવે એ પ્રમાણે તમે કોન્ટેક્ટ કરજો. પરંતુ પ્લીઝ 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 મેક શ્યોર ડોન્ટ જસ્ટ કોલ હિમ. એમને તમે ફોન નહીં કરતા, કારણ કે દિવસ દરમિયાન એ કામ પર હોય તો તમારા ફોનનો જવાબ ના આપી શકે. પણ એની અનુકૂળતાએ જરૂરથી ટેક્સ્ટનો, વોટ્સએપનો, ઈમેલનો જવાબ આપશે. પણ બિફોર with you, so a big round of applause for.
And really, thank you very much, Dipesh Bhai. And it's really important that આપણે Dipesh Bhai ne એટલું respect રાખીએ કે we don't overload him with just questions which are not relevant. Please keep the questions relevant. તો એ પ્રમાણે તમને પણ સરખો answer મળે ને, and then he's not wasting his time because he's doing these for us as his seva RPM family માટે બધા માટે કરે છે through his own will, and we have to respect that. So thank you very much, Dipesh Bhai. Give Dipesh Bhai a big round of applause.
Thank you, everyone.
Dipesh Bhai, please say good night to our YouTube family.
Good night to RPM YouTube family, and I hope everybody enjoyed it. And if you've got any questions, just feel free to contact me. A lot of times we'll probably know the answer straight away, so it's fine. It's not a problem.
Thank you very much.
Thank you very much.
Don't forget to subscribe. Don't forget to ring the bell for notifications, and thumbs up as usual, because Dipesh Bhai's talk today was very, very important, and it was very, very well presented. So thank you very much, Dipesh Bhai. Good night to our YouTube family. Don't forget tomorrow from 7 o'clock from Bhajans.